Our next guest says equities are still in the early catch-up phase. Joining us now, Chris Hyzy, Chief Investment Officer at Merrill and Bank of America Private Bank. The bull market powers on. That's the bottom line, Chris?
Yeah, it is. There's so many things going right for it. It didn't look that way in the fourth quarter of last year, and there was a lot of people throwing in the towel. But, markets are a little funny. You just look at one thing. If you have a lot of uncertainty, and that uncertainty that was basically all baked in does not come through, you climb the wall of worry, and a little bit of cash that comes out of large money manager cash piles comes into the market, you all of a sudden go back to new highs. And that's what we're seeing. And there's 4 or 5 main reasons. The trade war de-escalation, and obviously that's still a tail risk. We don't necessarily know what's going to happen there, but just a truce or a de-escalation, rollback of the tariffs, that's number 1. Monetary policy is number 2. And we get a lot of emails, et cetera, from clients about it's not monetary policy. It's all about profits. Well, that we know. But it is monetary policy. It's a lot about the balance sheet, the availability of liquidity for those who want it to do something with, to create transactions.
And not just for expanding multiples, but for the underlying earnings as well.
Absolutely.
Okay. And what else? You got 5
Housing.
things? Housing, okay.
Housing's another one. In a very sneaky way, housing is powering the U.S. economy along with regular consumer spending. Lower income, middle income, higher income are increasing their spending habits. We see it in credit card transactions. And then you start to look at the dollar. The dollar has weakened a little bit recently, and that is actually creating a saucer-like approach in the PMIs around the world. They haven't bottomed yet, but the second derivative has slowed down. It's not an excuse, but the first derivative is coming next year, and that's what the market's telling us.
Is that 4 or 5?
That was 5.
That was 5? Okay.
I'll give you a 5th one if you want.
Give me a 6th one. No. I'm sure you could come up with something.
Mike, when you said looking back at the charts maybe tells us where we've come, I can't help but look back to December of last year.
Sure.
Do we need to worry about that? What would kind of tell us that that's going to repeat itself?
I don't think we really do need to worry about something like that. For one, it was pretty extraordinary to have that kind of performance in the fourth quarter. And before that, when the market topped out in September, you had a lot of kind of things below the surface that weren't going well. It was very few stocks that had been performing at new highs in September. And you did have a market that was begging for a different monetary policy than they were getting. And right now, it seems like the market is relatively in tune with where the Fed has come after 3 rate cuts and stopping for now. I do think also the 2-year span shows you this mostly sideways move with a slight upward tilt. It's very similar to what we emerged from in late 2016 and also late 2012. You had these other 2 periods during this bull market where went flat for a long time, then broke out higher. Now, not to say we're going to get 25% on top of where we are, which is what those other moves got you, but it shows you that the market, because the cyclical sectors are starting to lead, it's telling you the market is trying to sniff out a global inflection point to the upside. Also, global markets are confirming what's going on here.
So it continues in the first quarter of next year?
Yes.
Upward momentum to where?
We could get above 3,300, and we could have another blow-off from there if a lot of the big worries don't come through. The 2 biggest worries out there that have faded is recession risk has basically declined to a very low probability. But the other one that's out there that still is the election risk, and that creates a lot of uncertainty, obviously, around the middle of the year. But up ahead of that, you could fast-track a full year's worth of gains up ahead of June, over 3,300. But the more important story, Joe, and that you like to talk about this a lot, is the long term. And it's easier to say long term because it's long term. But an equity culture is being built right now in front of us. Another massive equity culture. The millennials, the Gen Zs, over the next 20 years, far outweigh the Gen Xers. And if you think about the preponderance of fixed income and the very little equity culture that is with us right now, that should create this rising equity culture where yields stay low, and to create any kind of return in your portfolio, you need a higher combination of equities relative to fixed. So really the big story here is, yes, the next year is interesting, but really over the next 20 years.
And tech, financials, across the board. Emerging markets are set up better now?
They're certainly set up better right now. They're on the watch list. The watch list is many people are still underweight. We're still underweight. Non-U.S. equities in general, including emerging markets, are on the watch list for upgrade. As soon as we start to see real bottoming of the PMIs, that's a sign that emerging markets can contain their recent outperformance. But those windows close pretty quickly.